So let's look at the structure. So here is the same stock, it's trading 150. And if implied volatility is high, we might consider, this is the same two spreads that we put on. We're going to sell the out of the money 155 call. We're going to buy the 160 call against it. At the same time, we're going to sell the 145 put and buy the 140 put against it. So where the iron butterfly was, you could visualize it as the combination of a short straddle and a long strangle. The iron condor is the combination of a short strangle with a long strangle outside of it. It's a combination of two strangles. And the reason why people like iron condors is because it gives you a little more price movement, a little more wiggle room for the security to trade should it move. Remember that with the iron butterfly, we need that security to trade right around our short strike. In this case, and we'll look at these examples going forward, we'll have a wider break-even point on the position with the iron condor. Okay, so you have a little more wiggle room with the iron condor. The traditional condor, if the stock's trading 150 and implied volatility is low, but we want to put on a calendar or an at-the-money roughly long condor, we would in this case buy the in-the-money call for the 140 call. We would sell the in-the-money 145 call. We would sell the, we would buy the in-the-money 140 call. We would sell the in-the-money 145 call. We would also sell the out-of-the-money 155 call and buy the out-of-the-money 160 call, okay? It's gonna have the same structure. In other words, once again, we still want the stock to trade between our short strikes, but in this case, we're putting it on for a debit, and we would do so when implied volatility is rather low. The iron condor we would put on when implied volatility is rather high.